Hello friends, and welcome to this reading on cost of capital. Recognize that cost of capital is extremely important inputs into all the models that you're going to use in doing valuation. One of the common themes when we get to equity valuation or valuation of other assets such as real estate, it is a big time value of money problem. In any time value of money problem, you need the discount rate, and that is what this chapter is talking about. Obviously, if you are going to make an error in estimating discount rate, your valuation is going to be extremely erroneous, extremely sensitive to your input as far as discount rate is concerned. So I want to emphasize the importance of this chapter in your overall exam preparation for level 2. All right, so the specific things we're going to talk about is cost of debt, ERP, cost of equity, private company considerations, and then international considerations. Let's get started. So cost of capital, this is applicable to both debt and equity. There are two categories of factors. One is top-down factors, what I call as macro level factors. And then the second one is bottom-up factors, which are company specific. And let's talk about the top-down or macro factors, that they are important. And so there are four of those. Number one is capital availability, which basically determines the supply of capital. Remember, cost of capital is going to be based on the intersection of the demand and supply curves. In this case, the cost of capital is the interest cost or cost of equity, depending on the type of capital. But still, obviously, supply is going to be a big determinant of how much it's going to cost. In developed markets with developed capital markets, what you find is supply of capital is plentiful, so the cost tends to be lower as compared to emerging markets. Now, the second type of factor, top-down factor, is market condition. Whether you are in a recession or in expansion, growth, boom, whatever, the type of market condition will obviously determine the cost of capital. During rough times, during recessionary times, the cost of capital tends to be higher because investors, the providers of capital, are going to be a little more risk averse. The third factor is legal and regulatory condition. Those countries which provide high level of protection for investors, so you are looking at common law countries as compared to civil law countries. Common law will have lower risk premium as compared to civil law countries. Common law provides higher level of protection for investors. The legal framework is going to protect the investors, and therefore the investors are more confident in letting somebody else use their money, letting somebody else use their capital, and demand a lower risk premium as compared to in civil law countries. Finally, the tax jurisdiction and whether the tax's interest is deductible for tax purposes. And in those countries where interest is deductible for tax purposes, there is an implicit government subsidy for using debt capital, and higher the tax rate, higher the subsidy that is implied in using debt. It reduces the cost of debt. All right, let's talk about company specific or bottom-up factors. The first one is business or operating risk. This is basically captured by volatility of revenues, operating income, cash flows. So companies where the revenues slash operating income slash cash flows are more volatile, they are considered to be more risky, and therefore investors will demand a higher risk premium. Those that are more stable, they will have a lower cost of capital. The second is the asset nature and liquidity. Tangible assets tend to be a better collateral than intangible asset, right? So companies with a large proportion of tangible assets